Next up on the HyperFast Wealth Show, Sunil and I will be discussing good debt versus bad debt, a topic that can really impact your financial net worth. So stand by for the next episode of the HyperFast Wealth Show. All right, Sunil, how's it going today?
Good. I'm here in sunny Arlington, Virginia today for a change.
Well, it's always nice when the weather is nice. I'm down in the HyperFast Florida studio, so we got plenty of good sunshine.
Always sunny studio, yes.
All right, so today I think we should talk about good debt versus bad debt, because there's a lot of people out there that talk about how debt is bad and you shouldn't have debt. All right. But on the other hand, the wealthiest people in the world have a lot of debt. Most of them do.
Mm-hmm. Yeah. Well, let's talk about that. We'll talk about the different types of debt. I think that it's a topic that a lot of people don't understand very well. Again, people who are in the real estate world, who are either developers or kind of new to this thing, they know development, they know real estate, but the whole financing and debt side is something that I've also, learned over the last 10 years. So I kind of consider myself an expert in both the development side, but the finance side as well. And like you mentioned, I think you have, kind of two general camps of people when it comes to debt. At a high level, you've got the people who all debt is bad. All debt is bad. A lot of people who grew up in the Great Depression, who are kind of a little bit on the older side, just the idea of debt, like they just can't even fathom that. All debt is bad. Then you've got the other end of the spectrum, maybe the younger folks who, just charge it all up, right? It doesn't matter. It's dead. I can buy it today. Why not have it today? Why wait till tomorrow if I can have it today? But I think, the smart, wealthy folks, if you really see what they're doing, they're using debt as a tool. Debt is a tool, just like anything else. So if you think of it that way, you can use it to your advantage versus just saying it's good or bad. It's not black and white like that. Certainly, I don't believe much in, kind of consumer debt. I have no credit card debt. I have no, car debt. I still have a mortgage, but I'm trying to get rid of that as well. That mortgage is kind of questionable. We can talk about that in detail if you'd like. But I do have a lot of debt when it comes to our real estate projects, as you know. So I think if you can use it as a tool, if the debt's going to make you money, that's a simple kind of way to think about it. If you're going to take on debt and it's going to make you money, it's good debt. If you're going to take on debt and it's going to lose you money or you're buying a depreciating asset, then yeah, that's bad debt. Really, really think twice about that. So that's kind of, I think the high level overview of, of debt and why it can be good or bad.
Yeah. And I agree with most of that. Not all, probably one thing stood out, but that's what I liked best though, is when you said debt is a tool, which is because there's people out there that actually think money is bad and like debt, money is also a tool. If if you're a bad person, you can use it to increase that. If you're a good person, you can use it to increase that. So
right.
And that's really, debt is a tool. If you use it wisely, it's going to amplify that decision. If you use it poorly, it's going to amplify that. So
right.
You got to think of it as a tool and then ask yourself, how do I use it to build wealth, not destroy wealth?
Mm-hmm. Exactly. I think that, again, as you know, we have a fair amount of debt on our projects, and every project we take on has debt. When I first started, actually, my very first two projects, I did 100% in cash, partly because I didn't even know you could get debt on these type of projects back then. But mostly because I didn't want to, I was new to it. A lot of, I didn't have a track record. So a lot of people were probably not even going to lend to me anyways. But then I did those in cash. Those were successful. But then I realized, hey, I can go get, bank debt at relatively cheap rates. I mean, today we're getting it in the 4s, which is very, very cheap money. So it's a no-brainer, right? If you're going to, do $1 million project and you're going to put 25% of your own money into it, 25%, and let the bank finance 75%, that same $1 million, you can do 4 projects. Why wouldn't you do that? versus, just take all your $1 million and put it into one project. It's a no-brainer if you can leverage it with bank debt, and especially at the low rates we have today.
If you're doing a good project in real estate, whether it's buy and hold, flip, development, you should have minimum double digit returns on that. If you're, otherwise your criteria is a little off. I think you're picking a bad property. So if you can go borrow at low single digit rates, you're going to really compound how much your money makes. And that's why today, even you'll see people buy at big apartments that are stable and have been producing the same income. They'll buy them at really, really low cap rates, but they get the debt at a lot lower. And so, they're still able to get double digit cash on cash returns because of that, because of that leverage. Right. And if you do everything in cash, then, your margins just aren't going to be that high. You're going to, like you said, that same $1 million will do one project versus 4 if you use debt. So it allows you to scale and make more money with your money.
Yeah, it's a no-brainer. In terms of, again, as long as you're, again, I think anybody who you talk to that's been successful will pretty much say what I'm saying is that, again, if used properly, it's a wonderful tool. Imagine trying to build a house with no tools. That's going to be really tough. So the tools can allow you to do things that you couldn't do otherwise. Again, even another way to think of debt is like you were kind of alluding to. It's like even in an arbitrage situation, right? That's what banks do, right? They take our money and they pay us, very, very low rate, like 1%, and they're lending it 4 or 5%. So essentially their entire business model is just that spread that they're making. So the same thing with us. Why not do that? If I can get the money at 4 or 5% and I can make over 10% return on my money, why wouldn't I do that? That makes it's a no-brainer. Even if you were borrowing money at a low rate to put into like our fund, for example, where we pay 15 to 17%, it's still a no-brainer because you're still making that spread. And why wouldn't you? You could do that all day long and make a lot of money. That's essentially the banking industry. Their entire industry is built on that model.
Yeah, and I think maximizing your leverage, if it's with good assets, makes a lot of sense. So I just did this on a property I own, and the value went up, and I went to the bank to refinance just to get the rate down, from 4 to 3, which is amazing to even think about. But yeah, and then I saw the appraisal came in pretty high, and I was asked them, hey, can I take money out? And they let me take a chunk of cash out. It's not taxable. If I sold the property, now it's just money that I can go invest in. I'm paying just under 3% on it. So anything I make over that, I'm doing really, really, really well. So I'm instead of that equity kind of just locked up in that home, I'm able to scale and do more. Now, so I think for real estate, debt is good. I think you got to make sure you're able to pay it. All right. This is where people sometimes get in trouble. They buy a real estate property that, they can't afford to make the monthly payments if anything goes wrong, right? They assume this will, if prices go up and this happens, then they assume 6 things that need to happen for them for it to make sense. And then, one of them happens and they're screwed. So I think you got to think the opposite of that. Think it would take these 6 or 7 or 8 events to happen, all of them, for me to not be able to pay this back, right? Like any one of those switches is up, the circuit's broken, and I'm fine. So, have alternative plans for the property, have enough cash reserves, all that kind of stuff, right? If you're able to, make sure you have the ability to pay it no matter what happens, the debt's going to make you more money because you can ride out any cycle, down, up, sideways, whatever.
Yeah. That's again, what you're getting at is whatever you're using the money for, right? Like we talked about earlier, if you're taking money out of your house for a property, like you mentioned, and you're buying a brand new car with it, okay, hey, that's not probably a good idea because that thing's gonna be worth half probably in a year or two. So, you're still gonna be liable for that debt. But as long as you're using it for something that's gonna make you money and something where you're, like you said, it's not like a 50-50 is gonna make you money, but very, very certain, and a number of things would have to go wrong before that scenario wouldn't play out. Again, to me, it's a no-brainer. I've done, you sound like you just recently did that. I've done that over the years where I've taken, a lot of money out of some properties as long as they had equity in them through a debt, through a second mortgage or a home equity line, things like that. So yeah, I think it's, definitely the way to go as long as you're, smart about it.
Now you said you were a little on the fence about real estate debt for your primary home. So what's that all about? Why is that maybe different?
Yeah, I think because I definitely credit card debt, no. Pay your credit cards off, car debt, all that type of stuff, no. Primary residence, you can write off the interest. That's one big thing. So you do get some tax benefits of that. And again, it's like, what are you using the money for? So if you're, again, let's say you have $1 million house and you pay it off. If you can get a home equity line against it and still use that money to make money, then I think that's fine because you're kind of using that money that's locked up in your house. You can kind of think of your house as a big bank account, right? That's worth $1 million. And the only kind of downside with a 30-year fixed mortgage is there's not that much flexibility. You can't just pay it off and take money out in and out kind of thing. But still, I wouldn't, if you have, let's say, $100,000 to pay off your mortgage, but you could take that $100,000 and make 15% return on it, I would definitely take the $100,000, take the 15% return, because on the other end, you're probably paying 3-4% for your mortgage and you're getting a tax benefit on it. So that's why I'm kind of like, I don't completely agree in paying off your house.
Yeah. And I'm there with you too. I mean, if you can get under 3%, 30-year rate, like
it's hard to beat that.
But make sure you got reserves set aside, make sure you got the income to cover it, and then make sure you invest the money that you would have paid the house off with potentially. The one I maybe feel differently about than you is the car. Because you can, you can borrow for the car like at 3%. So
right.
If you've got a $50,000 car and you have $50,000 in cash, in theory, you could go buy it in cash, but I personally, and maybe not everyone's comfortable, I'd rather make a down payment on it, whatever they need, and then take the rest of that cash and go invest it, make 10%, 15%, and then, pay the 3% monthly on that. Cause then, now I'm making that 5, 6, 7, 10 point spread on the difference there. But, I would say this, like, make sure that you could afford to pay it off, then make sure that you can afford the monthly payments, and make sure you do invest, that money in something that can comfortably, safely beat the rate the loan is. If you can do all that, I think it's a different story. But
no, absolutely. I 100% agree with what you're saying in that aspect. I think unfortunately the average person who is out there is, they're going and getting car debt. They can, kind of not even afford the payment sometimes because they're always kind of trying to get a better car. And then they're not really doing anything with that money, right? They're just, they're not really taking the $50,000 of the car. They're just buying a $50,000 car that they couldn't afford anyways. And then that thing's worth, $25,000 when they go to sell it, and their debt is still $30,000 or $35,000. So I think in that scenario, that's a very, dangerous game. But yeah, if you're saying, hey, I can take $50,000, put it in this car, I can take $50,000 and invest it, and then, have the bank finance the car. Absolutely. Yeah. I think that's because car debt, like you said, is also very, very cheap right now. And you can almost get 100% financing on cars. So sometimes you don't have to put anything down, depending on your debt. So, and one other thing, types of debt, I think people, out there listening may not totally understand this. So I want to talk a little bit about that as well. Typically when you're, financing real estate, there's two types of debt. There's kind of like what I call residential or consumer type of debt, like the kind you would go and buy your primary residence with. And those type of loans are looking at you as a person. So of course you're buying the house, they're going to look at the house, get appraisal, those kind of things, but they're saying, what is your credit score? What's your income? They're looking at you as a person. But most type of commercial real estate debt, which I think a lot of people don't know even exists really, that's when I first started. I didn't even know this either. They're looking at the property. So they're saying, well, okay, you're going to buy this property and you're going to fix it up and sell it for this. Okay, those numbers make sense. We'll lend it to you. Or, hey, you're going to buy this property, you're going to fix it up and then rent it, and the cash flow will pay off our debt. So they're not looking at you. They still might, pull your credit score and things like that. But, the last X number of loans I did, the banks haven't even, they haven't pulled my credit. They haven't really looked at my financials. Really, I just give them some basic numbers. So they're looking at the property. So I just want people out there to understand that, if you're trying to get into real estate, if this is something, relatively new for you, look for those type of lenders that are looking at the property and do the numbers make sense. And again, especially if you're starting out, the bank is almost like another set of eyes, and they're going to make sure that you get into a property that's not going to, screw you, but of course, screw them is what they're looking out for. So those type of lenders tend to be, our local community banks, hard money lenders are always like that. And there are even some, I'm not using the right terms, but the residential side lenders who have products that are like that. So just want to make sure that people understand that type of difference as well, because that's a question we've had in a lot of our social media posts.
And one is recourse, another is non-recourse. Is that correct? Or maybe not all the time?
Yeah, the first type's always going to be recourse, the type when they're looking at you, because that's why they're looking at you, because they want to say, is this guy going to pay this back? They don't really look that hard at the property. The second type can be recourse or non-recourse. More of the development loans tend to be recourse, but yeah, if you're buying larger properties or cash flowing, there's a lot of products out there that are non-recourse, where the only thing the bank can go after would be that property, and all of your personal assets and you are protected. That's the difference between recourse and non-recourse. So yeah, I just want to make sure people kind of understand that that's there are a lot of different types of products out there.
Well, I think, overall, debt is a really effective tool if you use it wisely. You look at the richest people in the world, they're using it. The largest corporations in the world are using it. And, if you want to grow, if you want to expand, it's going to help you get there a lot quicker. Again, with the caveat of if you use it correctly. Like any tool used the wrong way can cause serious damage, but
exactly. If I use a hammer properly, I can build a house. If I hit somebody with it, it's not going to be a good situation. So it's the same thing. Any tool is good or bad. It's really the operator, the human behind it, of course. And one other thing I just want to throw out there too about debt that I think might help our listeners, especially some of the newer folks, is that I think there's also, like, when you're looking at buying a real estate property, just also understand there's kind of three general types of, like levels of debt or whatever you want to call it. Certainly you can buy stuff in cash, like we talked about earlier, that's, no debt. But again, you have to look at, if I took that money, what could I be making with it? The other end of the spectrum is kind of the cheap, non-recourse commercial debt, which we talked about as well, which is, tends to be in the 3s and 4s right now, very low interest rates, but a little bit harder to get because you're going to have a track record, and they are going to look at your kind of overall financial picture. But in the middle is kind of hard money as well. That is an option, especially if you're starting out. They're not going to be as stringent on what they're requiring. They're going to absolutely look at the property. You're still going to have some skin in the game. I personally am not a fan of hard money. I've used it a few times over the year, but I recommend actually not using it. But if you're starting out and that's your only option, then absolutely. It's a tool to get you to the level where you don't need it anymore, if that makes sense. Get to the point in your career where you can, just get the kind of the better, cheaper commercial debt. I personally kind of went from cash to the commercial debt. I use it a couple times just to try it. But just again, as an option out there for folks that are scratching their head and like, I don't have the credit, I don't have this, how am I going to kind of get this project done? Hard money lending, again, is a tool, if used properly, that can be very, very effective. And again, a couple other points which your listeners might find helpful on this is that, again, it's hard money is good. The two things just to watch out for if you're going to use it, number one is that it's expensive. And if you're doing a project, I remember the couple of projects I did with hard money, I basically, they made as much as I did in the project. So we were almost like part of the project. So it was like, next time I do this, I don't want to do all the work and they're making half the money. So that's one thing to understand. It is expensive, but again, it will get you kind of past certain points if you want to. The other thing to understand that because the rates are high on hard money, typically, it does put a lot of pressure on you to get the deal done. Like you might make decisions, you might dump a project quicker than you should have. I do remember actually a 5-lot subdivision I did. I had a kind of a hard money or second loan on it. And I think I did, looking back on it, probably dump it too quick because I was like, oh my God, 14% interest rate, everything. I'm looking at my monthly thing. It's just adding up and up. So just if you're going to get into the hard money thing, again, like I'm saying, I don't want to confuse anybody, but it is a good tool if you use it properly, but just be aware of those two things that you're going to face. It's expensive and it will put some pressure on you to perform. And if things kind of don't go perfect in this project, you're going to have a lot of pressure to kind of either dump it or do something with it.
Yeah, I mean, if your project has a big enough margin, enough profit in it that the higher rate you pay for it still makes sense, and that's the only way you can get the deal done, then it's something to potentially look at. You know, we've come across a lot of successful investors that used hard money, started with it, and some of them still stick with it for whatever reason. But if the project is good enough, if it's like a 25%, 30% or higher kind of deal, and the hard money is costing you 12, 14 even, I mean, there's still a big spread there. It's still going to make sense.
Yeah, again, it's like we said, if you need to use it, definitely use it. It's better to do a deal with hard money and make money than to do no deal at all. That's better. But if you don't need it, certainly, try to go with traditional financing, much cheaper, and it won't cost you as much and won't put as much pressure on you that something goes wrong in the deal. I got to get it done tomorrow, kind of a thing.
So if you want to get wealthier, get in more debt. Just make sure it's good debt.
Get more good debt, exactly.
All right. Well, thank you, Sunil, and thank you to all our listeners. Make sure you like, comment, and share this video, and we'll see you next time.
See you next time.
Thank you for tuning in to this episode of the HyperFast Show. Subscribe to us if you want to make sure you get the latest and greatest HyperFast shows. And remember, we love reviews. Reviews help us bring better and better guests and improve our shows. So give us the good, the bad, and the ugly. We hope you enjoyed the show, and we will see you next time.
Hey guys, thanks for sticking around to the end. If you want to see more videos like this, click right here. And if you want 10 tips from Sunil and I on how we've built wealth through real estate, click right here to download them instantly. And if you're new to the channel, click below to subscribe and turn on post notifications so you don't miss out.